Welcome to the Investing Show, where we discuss ideas to help investors make more of their money. I'm Simon Lambert of This Is Money. Joining me here in the studio, I've got Gervais Williams, Fund Manager of Miton Group, and Richard Hunter of Wilson King Investment Management. Gervais, you've made something of a name for yourself as a specialist in the smaller companies sector. Written a number of books about why you think those smaller companies offer a greater opportunity to investors over larger companies. Can you give us a quick answer as to why we should look to smaller companies over large companies?
I mean, if you look back, large companies and small companies have actually made cracking returns, really, for the last 3 decades. But actually, you could make good money in big companies, you can make good money in small caps, you can get good money in overseas companies. I think we're actually at a turning point. I think world growth is stagnating. Productivity across the world has been flatlining for the last 10 years. And I think that's going to lead to agility and the ability to invest for productivity improvement to become more important. Some big companies will achieve that, but I think more small companies will achieve that. And if you go back to the 1970s and 1960s, it was that ability to invest for productivity improvement which drove dividend growth, which led small caps to outperform for decades.
And so is that a reflection then that these companies, it's not necessarily anything to do with small cap versus large cap, it's more to do with the fact that they're more nimble, they're more agile, they can react to things better and make changes better to deal with the world than the huge global companies that we have nowadays?
Absolutely. I mean, I think you can get very agile big companies and you can get unsuccessful small companies. So absolutely, picking for stocks is very important along this way. But actually, when you come to a period where perhaps world growth is more sort of tepid, what is important is the number of opportunities. And it doesn't get easy to invest 10 billion when the world's tepid. There aren't loads and loads of opportunities to invest 10 million, but there's more of them. And so there's more opportunities for some small companies to find those opportunities, invest that cash, get that cash payback through cash payback, say, over 3 or 5 years. And as that cash comes through, to drive dividend growth, which is going to be quite difficult in future.
Putting technology to one side as much as you can, in that it's pretty much part of everyone's business these days, but putting out-and-out tech stocks to one side. In the small cap arena, what sort of sectors are hot to trot at the moment?
Well, I think actually what's interesting is actually that we've had a devaluation of sterling, so anything which actually gets a benefit from devaluation of sterling. So these are often companies which are manufacturing companies in the UK, and we still do manufacture. We've still got some very good manufacturing businesses in the UK and the services to the manufacturing areas. And of course, those companies which are competing against imports. So if you've got a service which you're selling against an imported service, then you've got a good chance of actually competing more effectively as well. So both those areas are attractive. But actually, I think the whole point about small companies is they've got a wider range of opportunities. It's a wider opportunity set, they've got more sectors they operate in, and if there are sectors which are stagnant, there are other sectors which are coming through and which are immature, which hopefully drive growth even when the world's not growing much.
And how small is small? Because obviously, traditionally, the really small companies are going to be reinvesting any profits in the early part of their development as opposed to paying dividends. So what's your sort of universe in terms of where you draw the line?
Yeah, we're open-minded, actually. We do invest in companies which are as small as 2 or 1 million market cap, believe it or not. But mainly, of course, we're investing in 50 and 500 million pound companies and that kind of area. So actually, it's an area which is very open. What's interesting is the quality of the opportunity and the scale of the cash payback. And of course, yes, we don't expect that to come back in dividends. In some cases, it's right for the company to continue to invest and get further cash paybacks going forward. But it's that stream of cash coming back which we're interested in, which gives them the independence. They don't need to come back to existing shareholders at a time when the market's distressed and dilute their existing shareholders at a time when perhaps the economy's had a setback.
And if you don't mind me doing a small piece of company stereotyping here, gentlemen, I think that when most investors think along the lines of typical companies and things like that, they think small caps, risky, large caps, less risky. They think small caps, growth, large caps, nice, solid dividends, reliable dividend payers. So that's not necessarily true, is it, from what you're saying?
No, absolutely. I mean, the trouble with big companies is that they can find themselves caught out by the market. I mean, Pearson was a sad case earlier this year where a company which has a very long history found it actually was over-distributing and had to cut its dividend by half, and of course the share price came back. And many small companies actually have balance sheets where they've got net cash balances or possibly small amounts of debt and very large amounts of unused facilities, which are getting cash paybacks where they can pay dividend growth when the main market's producing less growth. And that's the key issue. It's a bit of a one-by-one basis. As I say, you can lose your money very fast in individual companies if you get them wrong, and that's true of big and small companies.
So it becomes obviously well, for yourself definitely, but it's a portfolio approach. You need to be spreading those bets across a sizable number of companies so that if something does go wrong that completely holds the company under the waterline, it's only a small chunk of that portfolio.
That's absolutely right. We've got to make sure that the risks in the portfolio are not correlated. They're all different individual risks. But we do have to worry about is that when there is a net setback, and who's to say when it comes, what we do know is it's going to be very hard for anyone to cut interest rates very much. Our interest rates can't go down much. The US still can't cut interest rates much, even though they've increased their interest rates a tiny bit. There's not much opportunity to use quantitative easing. Quantitative easing last time in 2008 led to a surge of cash into the bond markets, into the equity markets, allowed a lot of companies to have refinancings and rights issues at the time. We can't do that. We're still using quantitative easing at the moment, so we don't get that opportunity. And even governments, which actually helped the recovery by running a bigger budget deficit, are not running surpluses. They're running deficits already. So again, they may find it difficult. So we've got to be very attentive to downside risk. You know, when companies get it wrong, they can get caught out, and if there isn't the appetite to raise new capital, then they can go bust.
And do you think are companies being punished more severely for when they do get things wrong nowadays? For example, a company brings out a profit warning, for example. Are they being punished more heavily on the share price itself, on the day that warning comes out and in the weeks afterwards?
I think the market can be very harsh and probably overreact at certain stages, particularly if they had an expectation that perhaps the underlying business was going quite well and it's completely out of the blue, where perhaps it's a little bit more kind of expected. They can see that the consumers have come down a bit. Perhaps they're expecting trading conditions to get a little harder. You do find that those share prices come down, but not quite so badly. But what's interesting is how far these companies can move over a 12 or 24-month period, because you might have the profit warning in the middle, but you can lose money before and after that period. And over a 24-month period, you can actually find that you've lost a lot of your value.
In terms of geography, have you got a natural home bias to the UK, or are you pretty much looking further afield?
What's interesting about small companies generally is that people think of them as small companies in that they're tiny companies, they're very dependent on a certain geography. Of course, what's true about our small companies is that they're small relative to Shell or BP. Yeah. So they are in many cases world leaders or one of the world leaders in an international geography anyway. They might have a home base in the UK, they might have international operations in the US or perhaps the Far East. But what's interesting about them is they have overseas sales, they have overseas operations. So many of our companies, they might be domestically quoted, but have decent, large international operations. So generally, we are interested in the UK, and we have got some core businesses, as I say, manufacturing businesses and such like in the UK. But if anything, we also see plenty of opportunity for some of the skills and the agility and the financing of the UK to be used in overseas territories. And if anything, we're getting involved in companies which are also moving overseas as well.
Do you have any examples of those kind of companies that you've
Well, I mean, a good example of that might be Acrol. Acrol is a company which actually manufactures tissue paper, loo paper, for the supermarkets in particular. It's an area where we've relied on imports in the past. Actually, they use paper from overseas, but they actually manufacture the loo rolls in the UK. They've been growing very fast. They're very much price competitive. They've actually had to increase capacity since they came to the market recently. This is a company which is actually about 140 million market cap, does about 140 million of sales, but is investing hard to actually increase the manufacturing capacity in the UK because there's an opportunity. Cost of imports has gone up and the cost of local manufacturing hasn't. So there's a good example of a UK company sort of operating in the UK with good opportunities, improving prospects going forward.
I mean, it's particularly fascinating at the moment with technology moving so fast. Tomorrow's Glaxo or AstraZeneca coming along potentially. So there must be a host of biotech specialists out there, maybe not just around the Oxford and Cambridge area, but there must be a number of fascinating opportunities in that space.
Yes, I mean, there certainly are. I mean, the UK has actually always had a leading position in the pharmaceutical and the biotech sector, and so that's actually an area which has been very exciting. In truth, we don't tend to invest in many of those companies because actually the cash flow is often negative for a long period until you get a big cash payback on an event, and we can't always be sure that event's going to happen, and the risk and reward ratio is very binary at that stage, so we don't tend to invest in that sector. The kind of things we're often looking for, though, also are companies which are quite small where there's great recovery opportunity. So we might take a company like Bilby. Bilby is a company which is involved in installing gas boilers and generally building works around social housing. It's an area where they have outstanding service levels. It has come to the market. It did have a setback when one of its major customers decided to take work in-house. That looks as though that's coming to an end. It looks as though they've got new contracts to offset it, but even the original contract may be coming back to them. So there's a business where the share price has come all the way down. So it's a market cap of only 40 million. It does about 75 million of sales, outstanding service levels, getting new contracts at the moment on a P of 7.5 or 8 on the current year through to March next year.
What do you look for when you're looking at those companies in terms of the characteristics of a stock that you're going to invest in? Do you screen for them first for something, or do you find the company and then have a checklist of things that you look for?
No, we very much don't screen. Recovery potential, you actually have to meet the company on a one-by-one basis, and then you only tell afterwards if they've got the recovery potential. I mean, what we're particularly looking for is companies which are investing cash for that cash payback. So perhaps one of our largest holdings at the moment is a company called Stobart, which is a company which used to own Eddie Stobart, the great trucking business which is all the way across the UK. They sold that business, they went into loss, and they invested hard in a completely new operation to supply biomass to biomass incinerators. And so from that point of view, they've moved from one business, and they paid a dividend, say 6p a year, uncovered for a couple of years, invested hard in all his fleet and all his stuff to get this biomass in, and the port facilities and such like. And it's only in the last 18 months we've seen the real cash back coming back on that. And so dividends this last year moved from 6p, whereas the cash came back, to 13.5p. Share price, which used to be about 125's moved up now. They've just put a statement out recently to say that they expect to pay about 18 pence of earnings this year, right? So the cash comes back, and suddenly there's a company which is nearly £3, about 2.88 at the moment. But what's interesting about it is it's not yielding 1 or 2%, it's yielding a bit over 6, even having a share price which has gone up 2 or 3 times.
And do you look at how important is the balance sheet and debt for you as well?
Crazily important. As I mentioned earlier, one of the things I do worry about is when we have a next setback is that the government and the central banks have relatively little wiggle room to help the economy and reflate the economy. So we do need to rely on companies which actually have very strong balance sheets in their own right. So you want companies with actually net cash balances, as I say, ideally. Not all companies have net cash, but if you have got debt, they've got huge amounts of headroom. So that if they do suffer a setback, they don't have to have emergency fundraisings. They can take advantage of the weakness of others at times of weakness. So if there's companies which fall over, they can move into those areas and expand their own operations, or indeed buy some of those operations from the receiver. So absolutely, balance sheets is crazily important, and we are very, very attentive to that issue.
So do some of those companies display then, or certainly show the potential to display some defensive qualities should the UK economy become tough over the next couple of years?
Absolutely. I mean, so, some of these have international operations. So a company like SafeCharge, which is not a tiny company, it's about 500 million, and this is involved in internet payments. So if you actually are buying something on the internet, you have to type your card details into an internet payment engine, and they make some of those. They're particularly well known in the European area, particularly. They do a certain amount of betting sites as well. But there's a business which is growing very nicely. It's got a very strong balance sheet. It's got about $120 million cash on the balance sheet, so unused at the moment, which is brilliant. But most particularly, there's a company which is expanding very nicely. We've seen its operations moving up. There's speculation about one of their competitors, PaySafe, being taken over quite soon. We don't know whether that'll happen, but that's actually in the markets today. But so there's good opportunities, but there's a terrifically robust business. Internet payments are going to carry on as much as we know, and on top of that, of course, we've got a business with incredibly strong balance sheet. If we see a consumer downturn and markets come down, there's a business that can take advantage of the weakness of others.
I think it's kind of a variation of a question Simon asked earlier. Certainly in terms of big caps, look at the FTSE 100. You've only got 100 stocks to have a quick look at and get a feel for, etc. How many stocks are you potentially looking at any given time in terms of your universe?
Enormous numbers. I mean, we include all the AIM stocks, of course. We include many of the smaller companies on the main list. We do actually invest in some of our multi-cap portfolios, even in some of the middle and large cap stocks. And then, of course, there's NEX. There's a few Channel Islands listings as well. So it's quite a wide range. The truth is, we can't keep up with the numbers, but most particularly, we just do very, very large numbers of meetings. And so on a day-by-day basis, we get many companies in. On a month-by-month basis, across the Miton funds, we might see 140 or 160 companies a month. And so we're just sifting, and it's a bit like panning for gold. You do find it there, but you have to work extremely hard to get to it.
And for individual investors who may decide to go down the route of buying individual shares rather than a fund, or actually many of our viewers will have both a selection of funds and investment trusts and their own portfolio of shares.
Yes.
What piece of advice would you offer to those investors who are buying into small caps? Because the small cap area is one that I think is hugely popular with individual investors, and I think mainly because it's so interesting. It's much more interesting than investing in a mega cap, in a Shell or a BP. You know, you can really start to understand a little bit about these companies. You can think that you can find the ones that you think are going to do well, but you can also come a cropper, as we will all know. But is there a piece of advice that you could give to those people?
I mean, I think one of the ways of which I find most helpful is to look at them in terms of how you would run the business if you're running themselves. And when you look at the business and you think of the decisions they're making, you think, if I was in that position, are those the kinds of things I would be doing? So it's a really helpful way. And specifically, when you're buying companies, I often find it's best to buy them when they're in recovery mode. You can buy a company which is growing very nicely, it's got terrific opportunities, it may continue to grow for many years, as many of some of the small caps have done over recent years. But the danger is that those companies which are growing pretty well have, to some degree, quite high expectations built in. Any particular missing of those expectations, downgrades and such like, can lead those share prices to suffer pretty badly. So I much prefer to buy companies which, for whatever reason, are out of the limelight, not well received. People are a bit fed up with them, because those companies, if they surprise on the upside, can make crazy amounts of money. So recovery stocks like Bilby and others are absolutely the way forward. And I think private investors who are willing to do their own work actually have the advantage, particularly if they're not based in London, because many of the companies out of London really hardly see any institutional investors at all. And so you, as a local investor, can keep an eye on the plant. You can see how quickly, how much their car park is filling up each day or not filling up each day. You can keep an eye on generally their local products and see how many trucks are going in and out. All of that stuff can give you a better idea than many of the professional investors as to how the business is going.
In terms of the share price and therefore the market cap, can a small cap get too large for you to continue to manage? I'm thinking specifically of a company like ASOS, as seen on screen, whose market cap certainly at one point could have catapulted into the FTSE 100, although they chose not to take that option.
That's absolutely right. I mean, what's interesting about that is there's a company which has chosen to stay on the AIM market. And there's advantages. There's the IHT benefits, of course. There's stamp duties cheaper and such like. So there are various advantages to be on the AIM market. And there's a business which, because of those advantages, has stayed on the AIM market, even though it could not just graduate to the main market, graduate to the main indices, the FTSE 100. So, yes, I mean, what's interesting about these companies is that something like ASOS and, of course, ARM before it was taken over, are companies which are very agile. They're taking full advantage. They're investing hard, many cases growing at a very substantial rate. So actually, I don't think the size of the company necessarily is the main driver. Look at how big Apple has become. It's still acting a bit like a small company in the way that it's moving and being very agile. So I think it's about the opportunity for the business to actually not just take advantage of its opportunity, but most particularly to harness the full value of its staff in a collective enterprise and drive growth. And there's plenty of big companies which can do that as well.
Gervais, I'm afraid that's all we've got time for. Thank you very much for joining us. That was absolutely fascinating. Richard, thank you for joining us. And thank you very much for watching. See you next time on The Investing Show. Goodbye.